reports that there's genuine stress for silver, lack of silver in China, that the supply chain has completely been dried. For the first time in 50 plus years, central banks not only are buying gold, they're buying silver too. We saw Saudi central bank purchase almost 30 million worth of SLV in August. As much as I almost choke on saying that, SLV, the amount that they bought would allow them to take possession. And then you get reports that foreign investors now hold a higher amount of gold than U.S. Treasuries. In fact, the share of U.S. Treasuries, they were saying, was down by foreign investors from 49% to 31% today. 49% in 2013 or 2012, somewhere in that neighborhood. But in other words, at the same time all of this stuff is happening, you're beginning to see real stress within the banking system, where we've seen these two big the auto supply and the other company, I think it was called Tricolor Subprime Auto Lender, and you know the private equity in dealing with some prime auto lenders. This company just went belly up and is tied to the regional banks. And you got Jamie Dimon, who comes out and says, this is like a cockroach, where you find one, there's lots more of them. You have the head of the IMF, Kristalina Georgieva, I think is her name. She said this keeps her up at night. And then you see the banks in the repo market. All of a sudden you have repo market where you're seeing banks starting to pledge, instead of treasuries, they're pledging their toxic assets like mortgage-backed securities, because the banks are stressing because of all the problems in the commercial real estate market. The banks are in trouble again, and you can see that by looking at the repo market, what's happening. So you have all of these things happening at the same time. Government shutdown, stress with the regional banks, private equity starting to fail, which puts more stress on the banks, on top of all of the things that we've talked about. And I think gold up for 9 straight weeks, I think, was starting to perhaps make some of the people, these large banks who hold these large positions, very nervous. And it's a coordinated attack. Who did it? Why they did it? What is the motivation? All of that stuff we may never know. All I can simply tell you is that the mainstream who comes and says all of this stuff, this is the same crap they've been saying all along, as gold and silver have outperformed everything since you and I did our first interview 3-4 years ago, and they said the same thing every single time. It was the same thing. Yet here they are continually revising their estimates. And when you see guys like Jeffrey Gundlach, who made his living selling bonds, come out a few weeks ago and say, 25% allocation to gold is not too much. This is a guy that is the bond king. When you see Michael Hartnett say 25% gold, or the CIO of Morgan Stanley say 20% gold, or Jeff, the head trader at Jefferies, say the next stop for gold is 6,600. You're seeing people at very, very, very high levels talking about this. You're seeing massive deliveries coming into COMEX, and you're seeing all of these things happen at once. There are some people who are scared, because there are people that are over leveraged and with an inability to access metal. And in London, it's a T+1 settlement. We've been told all year it's anywhere from 4 to 8 weeks delivery. There are stresses and strains, and it's a battle between the paper and the physical market. Who's behind it? What are the motivations? That's something I don't know. I can only guess and I can only speculate. But the more I hear of the mainstream narrative, the more I want to vomit. Because, yeah, a lot of it is true. But if it were true, you have to then talk about how it was resolved. And these things are not how they would be resolved. The way that it happened is not how it would be resolved. And so I don't think it's just normal market behavior. It's anything but. It's desperation manifesting itself in a drive-by shooting to create a perception of reality for whatever reason, to throw people off the scent. It's misdirection at its greatest level, and it's the same thing we've seen all along. And if you've been doing this as long as I have, a $250 drop in gold, yeah, it makes you want to puke, but it doesn't get you scared. It tells you you're getting closer to the point where the physical demand overwhelms the ability of these paper charades, these paper
Right.
drubbings that we haven't seen for quite some time, to be honest with you. But here it is again, and this one really reeks of desperation, as you can see by it happening one in only 240,000 days in a normal market. Michael Lynch says Barclays sold 1,969 contracts, RBC customers 1,076, and Scotia House account 2,024. And could it be profit taking from earlier buys? Maybe. But at 100 ounces a piece, when you're talking 2, 3, 5,000, 6,000 contracts, that's an awful lot of gold being dumped. We don't know who and why they would do it specifically, but he is saying it's the banks that are not the U.S. banks. Barclays, RBC, and Scotia are the ones that he points to, and he has all sorts of empirical data.
He has the evidence.
Yeah, you can go and take a look at his Substack. He publishes what he believes is the data and the footprints, the fingerprints to who sold. And I don't think it's just them, but again, it's like pushing a rock down a hill. And once it starts to move, it starts to, like a rolling stone, it starts, or a snowball starts to get bigger and bigger and bigger. It's getting bigger because it's triggering stops along the way. There were a lot of people that sold into this rally who would have probably hoped never, into this drubbing, that probably hoped they never would have had to have those stops triggered. But I think that's what happened in the middle of the night when you saw such a massive drop at a period of time when there was no liquidity, which just dropped the price. And then all of the triggers that would then automatically hit to sell to protect these funds from getting killed would only add to the drop. And then you had the value buyers come in and push it right back up. That's too coordinated to be coincidental, and too stupid to be stupid. No, I mean, yes and no. I mean, I don't think it's realistic to expect it to go straight up.
Sure.
But I think that from a standpoint of where it is ultimately going, I think it's going to continue to go higher. The bull wants to take as few people along for the ride as possible, Michelle. That I do believe. And so, I think that ultimately the markets will have their way. But again, you have a lot of very big players who are on the wrong side of this, massively short. Bob Coleman was talking the other day of the managed money being short 1 billion ounces of silver. In essence. And, that's massive. It's huge. So that means that there are other players on the other side of that would benefit from it. But, when you have that kind of volume on a system that is rehypothecating and trading contracts where, for example, you look at David Jensen, who's going to come on our show, he talks about 140 million ounce float in London that's trading 600 million ounces a day in deliverable contracts, with as much as 2 billion ounces in contracts out there that could stand for delivery with only 140 million ounce float. Now, what could possibly go wrong? And maybe that's why Eric Young is saying that the LBMA reached out to China and said, we'll take it at these obscene rates. We need it now. We need it. And we'll pay the high lease rates. Because of that, because when you play a game, and look, it's not just silver collapsing. If there was a major delivery failure by one of these banks in London, as an example, all of these banks are not just involved in bullion. They're involved in every single asset that could be traded across the globe. The systemic contagion of this would be catastrophic. It would bring down some of the biggest banks in the world. And this starts to move towards what Tom Longo talks about, on a coordinated attack against the Bank of England and the European aristocrats. And I don't know that to be true. Tom believes it. But all I can simply tell you is that, to me, the fact that it was done the way that it is done, and then you had someone come in and scoop things up, pushing silver right back up into the positive territory, tells me it was coordinated. It was coordinated by players, perhaps, to drive the paper price down, to accumulate physical at much lower rates, to make good on short contracts that were getting very close to creating this huge squeeze that everyone has been waiting for forever. Could it be that? Yeah, why not? Sure, there is some legitimacy to profit taking, to look, it's gone up too far too fast, and technicals say you should take profit. Some of that is true, and I believe that to be true. But that's cover for a bigger story as far as I'm concerned. And I think that's really what I take away from all of this, honestly. And I think it's hard to ignore it any other way. There are no free markets anymore, Michelle, just manipulations. But you can see the movement of these assets, these commodities, largely moving to the global south and east. And the exchanges that are popping up in places like Singapore, Shanghai, Dubai, Moscow, St. Petersburg, the BRICS facility that they're building, these will be the price setting mechanisms that will take over for the LBMA and the COMEX. Maybe not the COMEX if President Trump has something in store. Hopefully he does. But I would argue that the Western system of pricing commodities is coming to an end. And certainly those that are